Let's go ahead and get started. Welcome everyone to TradeFinder Live. Great to be back with you all during this trading day and during trading hours. First and foremost, as always, we do have to cover our disclosure disclaimer agreement. The main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing's to be taken as personal investment advice. This is always available on our website to be read in full detail at your leisure, or feel free to take a screenshot of it now if you like, but that's the main point to take away. Other than that, the market seems skeptical if Chairman Powell is going to be more dovish at Jackson Hole at the end of the week. And I think everyone is anticipating what that cut might look like, if there's any cut at all, and the impacts thereafter. And we also had the Dow pull back from its record. So let's go ahead and get into all that exciting material. Robbie out there?
I am Zach. Happy Tuesday, everybody. Welcome to TradeFinder Live. All eyes on Jackson Hole this week, as you said, Zach. And it seems as the market may be taking a little bit of a cue from, or at least the equities market from the bond market. We'll get into that. So here's a chart of the S&P. Chairman Powell speaks on Friday, so we have to wait till Friday to see what his comments may be. I've been opining over the last several of these live recordings that I think this is something that Chairman Powell is not looking forward to. The last Fed meeting, he couldn't wait to get off the stage, is what it looked like to me, and I don't think he's going to be too happy about the constant barrage of questions that I'm sure he's expecting about, is the Fed going to cut rates in September? Now, make no mistake, not only does the Fed Fund futures have an 83% chance priced in, which is down, honestly, of a rate cut in September. The equities market wants a 50 basis point rate cut. And it seems like now the equities market might be coming to the reality that not only would they likely not get a 50 basis point rate cut, they might not get any at all. So taking a look at the chart of the S&P, even though it feels like we've backed up a lot, and on the financial networks, they're talking about a potential correction and the fact that a lot of the big tech stocks that have been leading are selling off. From a purely technical standpoint, nothing has really broken down yet. You can see that we're still at the lower end of this ascending pennant pattern. We're still at this point above the 10-day moving average. That could change if we sell off hard into the close. We have sold off even more in the last 30 minutes. So we're a little bit lower than this price here, but not a whole lot. Still at the 10-day moving average and above this lower trend line. If you're long equities, what you want to take from this is that you're glad that some of the extreme bullishness is coming out of the market. You want that. That's the only way the market is going to continue to go higher. As we've talked about this numerous times over the years, when everybody views the market one way, it tends to go the other way. So if you do want the markets to go higher, you don't want everyone on the planet to be bullish, because the market's likely to go the other way. So I do think we're going to get kind of this pausing type of effect. You can see basically the market's done nothing for the past week. So what do you do when you see a pattern like that? Well, the first thing you want to do is go to volume and see, is there any sort of significant volume in the selling? And as you can see, there really isn't. We've had some red bars, obviously, with the market trading lower, but nothing like this, where it was significant. And that was on what I've deemed non-farm Friday, when the non-farm payrolls report came out so poor, showing with those major revisions that cost the head of the BLS, Bureau of Labor Statistics, her job, that we came back and we just have been kind of back and forth between the bulls and the bears. You can see we have green bars, we have red bars, but they're all about the same, which means that the equities market is kind of unsure where things go at this point in time. As far as the Elliott Wave, and by the way, if you haven't gotten a copy, if you're new and you're not aware of this, you can go to hub.com, HUBB.com, get a free copy of this software. You get free Elliott Wave. And then you have an opportunity, if you choose, not required to get the free software, but if you choose, you can subscribe to the AI signals. There's data scientists that basically have been the leaders since 2020 in using AI and technical analysis. You have the opportunity to subscribe to that if you choose. But the software and the Elliott Wave are completely free. The AI had given us just a little better than a coin cost, 62%, that we would hit 652. Now, the AI doesn't say we're going to do it on the wave three or we're going to have a wave four correction first and then hit 652. It's just saying that we're likely, based on all the 300 plus data points, which do include macro economics. I showed those in the U.S. market update over the weekend. Some of you ask, how can I get those charts? And I will have a meeting on Thursday with the data scientists. I'll ask if they're willing to publish those charts. All of the AI is proprietary to them. We just get the benefits of the signals. They don't give us the algorithm that they've created for AI is proprietary to them. I can understand that. But I will ask if the macro charts are ever thought to be published to where people can access those on their own. But when you look at this, nothing to be too concerned about yet. And then there's also been speculation on the financial networks this morning that if Chairman Powell stays as hawkish as he was in the last Fed meeting, that perhaps that could create that wave four scenario. The market will be disappointed, especially when it's leaning more towards a 50 basis point rate cut than 25. If you're not familiar with the term basis point, basically a 25 basis point rate cut is 0.25. It's a quarter of a point. A 50 basis point rate cut is 0.50. So it would be a half of a percentage point cut in rates. I don't know. I always think that the world of trading seems to have its own lingo to confuse the average person that's trying to learn this. I do my best to explain the vernacular that comes along in the world of trading. All right, so let's take the volume back off. I'm sure there's going to be questions. I'm going to try to allow a little extra time for Q&A today on a lot of particular stocks that look like they might be breaking down. But again, as far as the S&P in general, still technically for now, bullish. Now, if we break to the downside out of this, and will we do that before Friday? Maybe, if the market starts to listen to the bond market, which it seems like it's doing now. So I'm going to go ahead and switch over to the bond market, at least with TLT. And remember, TLT is prices on the 20-year. Prices and yields move inversely. So with prices moving down, that means yields and rates are moving up. A little bit of a tick up in yields today, or excuse me, prices today. So a little tick down in rates. But when you look at the bigger picture here, you can see that basically for the last couple of months, the bond market has been unsure. We're just going sideways, following an unusual trend out of the bond market where it was quite directional. Normally, the bond market doesn't have these kind of directional moves where we're all over the. Look at all these different patterns we've had. We had a very well constructed, I mean, as classic as it can get with Elliott Wave, with a 50% wave four correction, which you would expect to yield 100% extension. It went right to 100%. When a wave five ends, you go through a corrective phase, which is a flat, a zigzag, or a triangle. And we came back into a triangle. We broke out, formed another triangle, which is unusual to have back-to-back triangles. Looked like we were going to break down, then looked like we were going to break up, formed another triangle, came lower, went sideways, forming another triangle. And I think you could argue that basically this has just been an even larger triangle here. So the bond market is quite unsure of what the Fed is going to do. And the bond market's smart. Most people in the world of trading view that the smartest traders are in the bond market. There's certainly more liquidity in the bond market than in any other market. And hence, that's why there's a lot of smart traders there. And when they're unsure it factors back into the equities market of being unsure. We know that we have a lot of retail traders with a lot of cash on the sidelines, at least in evidence by the amount of money that exists in money market accounts. But even the retail trader seems to be a little less bullish than they were at one point in time. But I think we need to pay attention to the bond market being very unsure to see within the space of what 6 months here, 4 different symmetrical triangles in the bond market, quite unusual. I know a lot of you like to look at the TNX, so we show you that, and you still see the same exact thing. Now remember that TNX is showing rates, so where we had that downward Elliott Wave pattern on the TLT, we had an upward Elliott Wave pattern on TNX. So TLT showing prices, yields and prices move inversely. So when TNX is showing yields, you're going to see the exact opposite pattern as far as the directional side of things with the Elliott Wave pattern. But then there's those same 4 triangles on the TNX that we have on TLT. So once again, the bond market playing the middle ground, not sure what the Fed is going to do at this point in time. Taking a look at the dollar, that's been the one supportive move of the equities going higher. We're staying in this tight trading range, and I've talked about that before. This trading range I call Goldilocks. It's the best of all scenarios, in my opinion. We don't want to see the dollar go up substantially because that hurts companies with international exposure from an exchange rate. Keeping the dollar lower helps companies with the bottom line with the exchange rate. But in my opinion, we don't want to see the dollar come way down here, which is a possibility if the Fed does cut rates, and specifically if they cut 50 basis points in September. You could see the dollar come way down. And we just want to be careful on a drop in the dollar that we don't get to the point where the dollar loses its status as the currency of last resort. That's where my concern is, because then all you know what could break loose if the dollar starts to get to the point where countries are like, we don't want to hold dollars because we're losing money on those dollar holdings, and we're going to go somewhere else, whether it's crypto, wherever. That's really important. We do want to keep the dollar at the lower end, just not a collapse of the dollar is where we are dealing with that once again, in my opinion. So let's take a look at the other markets, and then we'll get into other equities markets, and then we'll get into metals, crypto, and energy. The Dow did make a technical new high. Finally, it broke its February highs. That was on the heels on Friday of UNH. UNH had a big update, added 350 points to the Dow. The Dow's performing better today as well, which is viewed as a little more of a safe haven. Kind of interesting to talk about the Dow as a safe haven, but it is. It's the 30 largest companies, so you feel like they're not going to be as affected as much as some of the higher beta names dealing with the equities world. But that was all on the heels of the disclosure that Berkshire Hathaway had taken a large position in UNH. I guess they feel like the selling has been overdone there, and what else could come out from a negative standpoint on that company. They've just been hit with news after news after news. It was all negative, and the stock has been crushed. It is the number one in the healthcare industry. It still is. But they have some issues to work through, and now the government's after them for their Medicare billing practices. So they've got that to deal with. But Berkshire felt, and remember, they look long term. They're not option traders, so they don't have a time constraint to what they're doing. But Berkshire thinks that over the long term, UNH will get its act together and come back. Now we've been hanging around that, a little bit better performance this morning out of the DIA than the rest of the markets, and maybe that's a little bit of a run to safety as well. Perhaps that's why bonds ticked up just a touch in prices today. Not significantly so, so you're not seeing a flood of people out of the equities market into bonds yet, which is another safe haven, but it makes sense that perhaps we're getting a little bit of outperformance from the DIA. Look at the Qs. That's the one where the high beta names are. Now it's Mag 7, Mag 10, whichever you want to call it. But you would think that based on what's occurred the last few days, that there would have been a major breakdown on the Qs. So far, we haven't. Again, things could change even into the close today from where we are right now. But we're hovering at the 10-day moving average, hovering at the lower trend line. And I've been talking about how impressive this channel has been. Trading channels, directional channels are very commonplace in the world of trading, especially when markets are trending, but you don't usually see them this narrow. I mean, it was just a steady march higher here on the Qs, and the fact that it's been such a thin channel, I've found extremely impressive. We were in the upper end of it, staying above the 10-day moving average. We had let me try it again, non-farm Friday, too many R's there, which looked like maybe we were going to break down, but no follow through, no confirmation day. So now we're just hovering in the lower end. We kind of creeped up towards the upper end and we're trying to hold this. And the thing that I'm interested in is it's only Tuesday. Powell doesn't speak till Friday. What do the markets do before he speaks on Friday? Friday could be a wild day in the markets. So I think there's going to be a lot of intraday volatility as every single comment he makes is going to be dissected. And if you're an intraday trader, perhaps there's going to be some opportunities there with maybe some big moves, overextended moves on any potential comment that he makes. Again, in my opinion, I don't think it's going to be a long speech. I don't think he's going to be on the stage for very long. He just seems to be he seems to want to be in the background, trying to talk a little too fast here this morning, as I did want to get to an extended Q&A, so apologize for the tongue-tied. But again, nothing really significant breaking down out of the Qs yet from a purely technical standpoint. Now, if we go to the IWM and look there, this one you would think, because it's where the highest beta names are, the small caps, would really be breaking down. And it has broken down today, but we're still right around the 10-day moving average. So again, not a purely technical breakdown yet. It just feels like it if you're looking at the IWM. But on the positive side, we did finally hit 230. I thought we would do it back here in July. Took a little longer than I expected, but once we got above 220, you've heard me talk about this over the last several weeks in TradeFinder. I thought we would hit 230. We finally got there, and then I said once we hit 230, I have no idea where the IWM is going to go, and I still feel that way. No idea whatsoever. I think the IWM will be very dependent on what Chairman Powell says. If he's hawkish, we probably start to break down and maybe this wave 5 is over. It is in the tap box, time and price projection, as the algorithm is written for this software. And again, if you haven't heard me say this before, the folks at Hub programmed the Elliott Wave algorithm exactly as Ralph Nelson Elliott wrote it. In other words, there's no personal adaptations. There's a lot of Elliott Wave softwares out there. Most of them do include personal adaptations from the people that are creating their software. This is just pure Elliott Wave. It's just exactly as Ralph Nelson wrote it well over 100 years ago. So I call it pure Elliott Wave, and that's what I like. If I'm going to follow a trading system, I like to follow it the way the creator wrote it. Just like RSI and DMI were written by Wells Wilder. And he was a mathematician, not a trader, just a mathematician that wrote RSI, very heavily watched. To me, I prefer the DMI. One of the reasons is it's not as heavily watched as RSI. I think numbers can be skewed and lag a little bit when there's too many people viewing the same indicator. Hence the reason I like the DMI. But we are in a point where I think the Russell is just going to wait and see what happens on Friday. So if Powell is hawkish, I think we correct at least down to the 50-day moving average, back down to that 220 level. If he's more dovish and signals that perhaps a rate cut is coming in September, you might get another leg higher in this wave 5 on the IWM. Let's go to the crypto market, which had a heck of a run, consolidating now. If you're long cryptos, and here's the BITB. I know a lot of you like IBIT. Both of them are very liquid in the world of options. IBIT does offer weekly options. BITB does not, but they both are liquid in their options on the ETF. So this is a way to leverage trading Bitcoin if you're interested in that. And if you're following the crypto space, you need it to hold right here. You can see we're testing the 50-day moving average. Again, trending patterns typically test the 50-day moving average periodically. We did it back in June. We're doing it again here. But it's also where the top of the wave 3 was. So if we break below this level, very crucial level on Bitcoin, if we break below it, that probably means this wave 5 is over. It is in the middle of the tap box, and we could be following lower down towards this wave 4 area here. So very critical area for Bitcoin to hold right here. And then Ethereum, I talked about this in the US market update. Tom Lee came out last week. Now he has Bitwise, so he has a dog in the fight, if you will. And sometimes people come out and talk their books, but he thinks that there is going to be a flip-flop where Ethereum becomes king and overtakes Bitcoin as king of crypto world. We'll see. Seems kind of bold, but for now, we got a little bit too vertical on Ethereum, and we've come back down. What goes vertically up oftentimes comes vertically back down. The level that you want to see hold is right where we are here. So really important for the crypto space to find some support where we are right now. If not, then we're subject to moves lower. I'm not saying there's going to be a collapse in the crypto space, as some people are. I don't think that's going to happen. I think there's way too much interest and way too much money moving into cryptos, but we could correct a little further first. You can see the 50-day moving average on Ethereum is way down here at 25. We could easily see that if we don't hold right here around this 29 area. So again, line in the sand in crypto over the next couple of trading days. Looking at the VIX, it's not really reacting too well at this moment. The VIX is at 15.5. We closed at 15 yesterday, so we're staying slightly elevated. Some of you pointed out, because I always talk about this, that last summer we hung around the 12.5 level, and this summer we did not. And people were saying, well, we're not in summer anymore. And I'm going to go with the calendar and say, technically we still are. We don't move into fall till September 21st. So technically we're still in summer, but yet we've had a slight elevation and volatility throughout this entire summer. And 15 being the low rather than 12.5 like it was last summer. And that's the question. Do we break down and test 12.5, or does 15 hold and we get another spike up like we did at the very beginning of August? And I think Friday's going to tell the tale there as well. So all eyes will be on Chairman Powell on Friday. And then we get the PCE report. But I feel like what he says in Jackson Hole is going to carry more weight than the PCE. We've had enough inflation indicators to know that inflation has come down considerably. It's still higher than where the Fed says they want it. And, you know, that's where the argument is. The Fed staying on pause has been because inflation isn't quite as low as they want it. But the ones that want a rate cut are saying, but inflation has come down significantly. Go ahead and cut rates. And if inflation starts to go back up, then you can go back and raise rates again. But let's get in front of this and cut rates. And I can understand that argument. It takes a while for a rate cut or a rate hike to work its way through the economy. It's not an instantaneous thing. I use the analogy. People that listen to me a lot know that I use a lot of analogies. It's like an aircraft carrier turning in the ocean. It takes time. And rate cuts or rate hikes are not instantaneously stimulus or corrective in the markets, because it just takes months for them to work their way through the economy and for it to be felt. So I do understand the argument, step in front of it and cut rates now before things get too bad. Because if the Fed waits until the economy weakens too much and the job market weakens too much, even if they cut rates, it's likely that those are going to get worse before the rate cut comes into effect. So I understand both sides of the argument. I really do. I wouldn't want to be the chairman of the Federal Reserve. And I've been super critical, not just of the Federal Reserve, but the fact that we have an independent group that controls all of our money. And then I have to acknowledge those that say, it's probably better that there's an independent group controlling the money of the U.S., because with all the craziness that you see in Congress, et cetera, maybe having an independent group is better. But just from a purely um, patriotic standpoint, it just feels like um, the government should control money, not an independent group. The reason for that is the Fed makes a ton of money off controlling money, and that's the part that bothers me. If the U.S. controlled their own money, if they did a decent job, we wouldn't be in the debt that we're in right now, while the Federal Reserve is making money. All right, end of soapbox. Let's go ahead and look at the metals. When we take a look at GLD, we're trying to sneak to the downside here, but not enough to say that we're getting a downside breakout. All I can tell you is that there is going to be a significant move in gold, and it's coming very soon. Can't tell you what direction it's going to be. Nobody can understand that. You can see all kind of predictions on where gold's going to go. When you have a triangle that's that big and that long and that well formed, no one knows which way gold is going to go. Nobody. The ADX is very low, is starting to tick up. Maybe that's a sign that something is getting ready to happen. Another analogy that I use, when you see the ADX tick up while you're still in a triangle formation, is like lava underneath volcanoes. And gosh, there's been all these forecasts that we're going to have a whole bunch of volcano eruptions. You've probably seen all that kind of stuff. So it kind of ties in with some of the conspiracy theories that are out there right now. You saw the animals are leaving Yellowstone because they sense that the volcano is about to erupt. They're just going following their normal migration cycles. But man, in this world of social media, things get out of control pretty quickly. But I stay with the technicals. The ADX is very low. We've had this long consolidation, and the ADX doesn't normally get this low. Perhaps with it starting to tick up, the lava is rumbling underneath the volcano. The top of the volcano still looks peaceful, but we don't see what's going on underneath. Maybe we're gurgling towards that breakout in gold. And I've given you an idea based on the width of the mouth of the triangle. If gold breaks to the upside, we're probably looking at somewhere near 330. If it were to break to the downside, we're probably looking at something near 290. So again, nobody knows which way gold's going to go, but those are the two target prices to watch on a breakout of gold. And then I've been talking about how SLV didn't have the same triangle. It had a very symmetrical, as you can see these lines that I've drawn here, wave 5 pattern to the upside. It held, the AI called this back in May, where silver was likely to go. That was the target line. It sat there for an entire month, broke higher, came back down, tested it, also coinciding with the wave 4 and the 38.2% fib retracement level, broke up, formed a much smaller triangle, but finally a triangle. Nothing like the one on GLD, but a triangle nonetheless. And we're kind of testing that 50-day moving average right now. If we look at the ADX, you can see it diving down, is trying to play catch up, but nowhere near as low as the ADX is on GLD. So I would expect that the significant breakout move will come in gold first, and then we'll see if SLV plays catch up. Looking at natural gas, same thing. Just no interest in going long in the natural gas space, moving lower here. Tried to hold 12.5. We didn't. Now we're in the exact middle of the tap box at exactly 100% extension. So we had roughly a 61.8% wave 4 correction. That also yields an expectation of 100% extension on the wave 5. That's where we are. And now if we don't hold right here, right at this area on natural gas, we're probably coming down even lower, maybe down to 10 or so. And we know there's going to be demand for natural gas with all the data centers that are being built, et cetera. But the markets are supply and demand. If you want to summarize how the markets work in general terms, supply and demand driven by fear and greed. That's how they work. That's it. That's a one sentence explanation of how the markets work. And at this point in time, our supply, and we have a lot of it, is outstripping the demand. And that's why natural gas is going lower. We do have the winter season on the horizon. The market always looks 6 to 9 months ahead. Well, we're in the middle of August, so that would get us into midwinter. And yet that still hasn't turned natural gas to move to the upside. I've been opining and have not looked at the Farmer's Almanac, which a lot of people do look at for forecasts on natural gas. We had in some of the travels that I've done, pockets of the country that had very, very unusually warm summers. And I was wondering, does that mean we might have some pockets that have very unusually cold winters? I don't know. I don't know what the Farmer's Almanac predicts. Maybe not. Maybe it means we're going to have a mild winter. And that's why natural gas hasn't caught a bid. But I know that a lot of people in that space do watch that. And then looking at oil, oil is the one thing that I have really nailed, staying in this trading range. Talked about it at the very beginning of the year. I thought oil would stay in here, and that's just based on OPEC. And the fact that they're trying to manage that supply demand that I talked about. They want to keep oil prices slightly elevated so they can make more money on the supply they have left in the ground. They've done the geological surveys. They know they're starting to run out. I mean, they got a ways to go, but it's noticeable now. They want to make as much money as they can with what they have left, but they don't want oil prices to go so high. It's counterintuitive. You think, well, if they know they're running out, they would want to make as much as they can quickly, so they would want oil prices to be elevated. But then they could break that supply demand curve. And if oil prices get too high, it's just going to run more people into electric vehicles. They kill the demand, and then prices drop. And I think the moves that OPEC Plus has made are indicative of that. When we had this spike up during the Israel-Iran conflict, OPEC increased production. Then when we had this spike here, they increased production again, and they've stopped those what look like maybe breaks to the upside on oil. So I think we stay in this range for the rest of the year. I think the status quo on oil, which makes it difficult to trade from a directional standpoint. What do you do there when it comes to it? I didn't do, or I don't do the U.S. market updates with international stocks anymore. I prefer to try to get in as many stocks as you guys are interested in. So it would just be a much longer recording, try to be respectful of people's times on the weekend. So I'll go around the world real quickly here. EWA just kind of hanging around here as well. We did finally hit 27, which I thought we would do back here. Once we broke above 26, I thought we were headed to 27, and every time it seemed to try to move there, it came back down, held the 50-day moving average. We finally hit 27 once again. No idea where the EWA is going to go. If we break 27, I can tell you we're likely moving into this tap box. That part I can tell you, but this area could hold, and we start to break down towards this previous 4. And that's going to go a long way, I think, with which way gold breaks out, because Australia is very resource rich. I've talked about Canada a lot. One of the markets that has been most surprising to me over the last several months, because even though there's been negative talk between the U.S. and Canada regarding the whole tariff thing, the market, at least as evidenced by the EWC, seems to have ignored that. and we just keep trending higher. And maybe we come down, test the 50-day moving average again. We did it back in July. Maybe we go do that again. We did set a new wave 5, but there's a potential to go much higher on the EWC as long as we hold above where this wave 4 was. Or you could say that we go lower. But the thing is that the algorithm has labeled this as the wave 4 is done, and that we're now in the wave 5. And that means that perhaps we are coming back down towards this wave 4 in Canada. I think what happens here in the U.S. market, especially on Friday, we'll have a long way to go on what happens with the EWC. Now we go to Germany. I've been showing that market because it's just been so wild. Now acting a little more normal. I'm surprised that it's not down further. It moved higher as a lot of the markets in Europe did due to the fact that the ECB has been way ahead of the US in cutting rates. They cut 200 basis points. We're hoping for a 50 basis point start. So way ahead of us there. Markets love the Kool-Aid. They love rate cuts. And when you look at the fundamentals of Germany, as I've been talking about, they do not warrant this run up. The fundamentals in Germany are not good, but yet the market went higher and it went higher because of the rate cuts. And now we're just kind of trending sideways here. We did extend more than 100%, which means if we do correct in the EWG, if it doesn't go higher and when we're in the upper end of the tap box, so you would think this is an extended wave 5 move, you look for a correction back towards the fib level as far as 61.8, but likely not lower than that. If the wave 5 extends less than 100%, that's when you look for a correction back to the previous 4, not when it extends more than 100%. So the first level would be a 38.2% correction and coincide with that wave 3 high. We got to break down below the 10 and 50-day moving averages first, so ways to go before we start looking at any sort of a significant move down and EWG. If we look at the Nifty, for the market in India. We saw this when we looked at the charts for our subscribers at ewotrader.com yesterday, a live show that we do for them on Mondays. We saw this break to the upside in India, and perhaps that's going higher. It does seem like there's some rotation going into international markets, which is going to tie into our case study consideration for today at TradeFinder. We're going to look internationally and not try to pick what's going to happen here in the U.S. At the end of the week. And we move upside again on the Nifty. And we have broken above the 50-day moving average. If we hold here, then that would count as a follow-through day and likely more upside to come in the Nifty. Even though we're a little above the 10-day moving average, we could have a day or two of backing and filling, but it does look like we're moving higher in the Nifty, the market in India. And then looking at China, we had a alert at ewotrader.com on this, and we kind of nailed it. We got out here and then broke back down, tested the 50-day moving average, looked like it was about to be off to the races and have come back down. There is a potential for this to move higher, but note that this wave 4 is green, which means the algorithm views the wave 4 is still active. In other words, we could come down and make a lower move on the wave 4. Is not convinced that that wave 4 is in, and we'll see if we turn and go back to the upside further or come back down. So kind of unsure there on the market in China. It does seem like the U.S. and China are at least working towards a trade deal. I imagine it's pretty complicated. President Trump keeps rolling out the deadline, so apparently he feels that there has been some sort of constructive movement in negotiations. Otherwise, he, I think, would be a little harsher on what the rhetoric is regarding tariffs on China. All right, so with that, Zach, let's get to as many questions as we can before we come back to the case study. Idea will be an idea this week. We've just been doing posts the past few weeks as the AI with the software has been keeping us out of too many long positions. So the AI has sniffed out that this would be a period that's difficult for movements to the upside. but it is showing some interest in international markets, and that's what we're going to do today. So, all right, Zach, let's get to the Q&A.
Sounds great, Rob. Let's get right into it. Question from Will. Can we look at PEP? Do you think it's bottomed?
Well, that's a really good question, Will. And you oftentimes ask good questions. With the slight outperformance of the Dow stock, this is an area where money goes to hide. When you feel like some of the higher beta names might be susceptible, might be overvalued, et cetera, the big boys, the institutions rotate into these stocks, Coke, Pepsi, those kinds of things that tend to be good safe havens when you're concerned about trading in the higher beta stuff. And that's a pretty significant move. And I'd like to look at this zigzag here and see what that looks like. And we're perfectly a 50% corrective move. We've hit 61.8. If we have a 50% B wave correction, you look for 100% extension. So I'd say there's more upside to go in Pepsi, maybe up around 156, 157. We're a tiny bit above the 10-day moving average. I wish it wasn't going at a degree higher than 45 degrees right now. I'd rather see it more along this line. So a day or two of correction is possible, but don't let that shake you out, I don't think. Zigzags, as you know, I love. And this wave 5 ended under 100%, which means you likely move back to the previous 4. So Will, based on the Elliott Wave pattern, it would say, yes, it balanced and it created a really nice. Zach and I used to talk about this all the time when I was living in Florida. Both my parents were heavily involved in the space program. I grew up around space, so I labeled this kind of pattern the launch pad effect. When you have a very sideways pattern like that, it acts as a bit of a launch pad for a vertical move. It's exactly what Pepsi did. Came back, corrected a bit, and is moving higher. And notice that the C wave extension almost brings you exactly back to where that wave 4 was. So I think that's a good one, Will.
Agreed. I know you covered silver and gold, but specifically, there's a question here from Bruce on your thoughts on the gold reset to 15K, 20K.
Yeah, it seems like maybe if that was going to be a major effect, it would have done so already, and it really didn't. So, you know, I really don't know. I wish I could give you a more definitive answer because I know that's what you're looking for. It just, based on what's gone on, it hasn't seemed to affect things. So, there's crypto come out. You can tell me, Zach, I know there was a crypto coming out backed in gold. Has that been released yet? Are you aware? You know more about crypto than I do. Um, and I felt like that was interesting. I don't know if that got upended by the Genius Act and the stable coins and stuff, the legislation that was passed in order to kind of shore up the dollar so we don't get a collapse in the dollar. And maybe there's some less interest that there was at one time in a crypto based on gold or backed by gold. I don't know if you're aware of whether or not that has been released yet or not. But as far as gold itself, it didn't really seem to have much of an effect in the gold market in general. I think it's going to be more based on inflation and what the Fed does as far as where the big move goes in gold. And it seems like the administration is leaning more towards cryptos as a way of shoring up the dollar than the metal itself. I don't know enough about it to give you a more definitive answer than that. That's all I can do is read the charts at this point in time.
Yeah, just for a little context there, Rob, there is crypto backed by gold. There was some changes, modifications based on the Genius Act, as you mentioned, but there's the ERC20 token, which is through the Ethereum blockchain. And just in short, each token is equivalent to 1 gram or 1 troy ounce of gold. And so for a symbol example would be like XAUT, which would be Tether Gold, and there's Paxos, Digi. There's a whole bunch of different ones, but yeah, there's a lot to still be shown and play out for that.
All right. Well, thanks for the context. Again, you know more about it than I do. All right. Next.
Next up, we have a question from Barbara. Should I sell AMD at this time?
Um, I actually have AMD as well, and I'm feeling the same pain today that you are. But from a technical standpoint, we look at this. I'm wondering if that was perhaps a false upside breakout. We came down yesterday, still felt good, tested the 10-day moving average, filled the gap, and right back to the point, which happens oftentimes when a triangle breaks out. You break out. Sometimes you break out and run. Sometimes you break out, come back and test the point of the breakout, and then you run. Other times it's a false breakout because there was no follow through day on AMD. That's why I keep talking about these rules. And so it kind of led you to believe that maybe a little bit of a pullback, but holding that point of the triangle was no big deal. Today's more concerning. And we need, again, follow through. So, if you have a longer term horizon, I don't know if you own the stock or if you own options on the stock. Obviously, that creates a different point of view on the amount of time that you're willing. If you're holding the stock, we could easily come test the 50-day moving average because look how long it's been. You got to go back to May since the last time we tested the 50-day moving average. We could easily come back and test that again. So that would be a little bit more discomfort in the meantime. But in addition to the 50-day moving average, there's a little bit, not a lot, but a little bit of support right here in the 150 area, which could also act as support. So if we do come down, 150 area, 150 to 155 could be a point where AMD finds support for potentially a bounce. The positive side of things is the algorithm is still saying the wave three is active. It's not convinced that wave three is over yet. And that's why I'm still holding it because you know what normally happens, the whole max pain theory, when things start to go against you and you see your trade going into a drawdown or your account going negative and it's just like, oh, I can't take it. Nobody likes losing money. Nobody likes seeing their accounts go down and like I can't take it and I get out. And as soon as we do that, as soon as we reach our max pain point, oftentimes from a psychological standpoint, that's when the stock's getting ready to turn and go back to the upside. One of the things that I've learned over a long period of time is patience, even though things are going wrong. And one of the things that is helpful in that is it's never fun to have a losing trade. It's never fun to lose money. We're all going to do it. Every one of us in the world of trading is going to have losing trades and lose money on trades. But if it does break down, we can flip the trade and go the other way because the argument would be if we break 150, the next level of support is down here in the 125 area. So if it does do that, then we could go short and recapture some of that. I do that a lot with adjustments. Sometimes flip things and people say, "Oh, hey, you're just flip flopping with the market." Well, kind of, yeah, because if the pattern changes, change with the pattern. It doesn't mean that you have to stubbornly stay with an upward pattern if the pattern has told you it's changed and different. And that's why I like Elliott Wave so well. To me, it's by far the quickest technical indicator to change with the market. If the market changes, it readjusts very quickly, where a lot of technical indicators are lagging. It's the fact that it's still in a wave three is why I'm still there. And I do feel like if we come lower, then we break 150, you short down to 125. So for now, today, as bad as it feels, I don't think today is an exit, but we might get there over the next few days, but not yet today.
Thanks, Rob. Question from William around UNH specifically, how low you think UNH may pull back for a good buy if getting it at 280 might be in the cards.
I think maybe it had that big gap up and We had a bullish trade on UNH that didn't work out well, and we adjusted it. That wasn't going well, and then all of a sudden we got that um, news that Berkshire Hathaway had taken a position in it, and that helped us recover the loss on the big move to the upside. So that was quite timely for our alert. But it got a little overextended, right? So it went too high. Not much of a follow through day, which told you that we're going to probably come back. So the question is, can we hold the 50-day moving average, or do we need to come down and test this level? And as you talked about, around 280 would be an ideal entry, I think. Berkshire doesn't, well, they do trade options. They're the largest options trader in the world, but that's a whole nother story with the way they do it. But looking at that, if we could come down, fill that gap, hit 280, test the 10-day moving average, that would be an ideal entry for them, and then our entry for it. But I often talk about how the market doesn't always give you the ideal entries. If you could get 280, yes, I think that's a great entry on a little bit of a longer term, because they still have some things to work out. But Berkshire, those guys are pretty smart. And so they feel like over the long term, they're going to get their act together. They're going to get things figured out. They'll get past this Medicare thing with the government. And then longer term, you're going to see them move back to the upside. You can see it ran up, hit this resistance on this sideways move here. And by the way, the launch pad, as much as we like to talk about them blasting off, the launch pad also gives you breaks to the downside as well when you consolidate sideways. But we ran up, bumped our heads in all this resistance. We're backing up. I'd love to see it come back down to 280. I think that would be interesting in a longer term position as well. So I'm with you. Let's hope it gets there. But the one negative, the one fly in the ointment, is the market doesn't always give you those ideal entries. But let's be a little patient with it, see how it handles the 50-day moving average, and see if maybe we can get that 280 for an entry. One thing I can tell you is if and when, and I do think it's more of a win than if, it does break above 300 with follow through, you could see a move to 400 rather quickly on UNH, and that could be a great trade. Well, let's see if we get the ideal entry for it or not.
Thanks, Rob. Perhaps the inverse of the launch pad could be an earthquake or avalanche, another term that we can come up with for the opposite effect.
Or what's that big rocket that Elon has? What's the name of it? The one that's going to propel to Mars, the one he's been testing.
Yeah.
What do they
Blanking
call
at the
that?
moment.
Yeah.
Starship.
No, it's not the
No.
Starship. It's the big booster rocket. I forget the name of it, but it's
Yeah.
massive.
Blanking on it as
Anyway, what I
well.
was talking about is the first time they tested it, it completely blew out the launch pad. It just obliterated the launch pad because it was so powerful, and their engineers felt like it would hold it, but it didn't, and it just blew out the launch pad. I think that's a good analogy too. But anyway, we'll look up that and we'll rename it based on that. If anybody knows what that big huge rocket, not the one that's been being used in the Falcon 9 and all that kind of stuff. There's a name for that big massive one. Anyway, let's move on.
Thought it was the Starship, but I might be wrong. Anyhow, you mentioned Berkshire. Will would like to look at BRKB.
The interesting thing about Berkshire is the new management going to have the same magic touch? I do think that Warren Buffett still has his hands in the mix a little bit, just not in the day-to-day operations. I wonder if they have to run it by him before they make a big purchase. Just curious there. You know how Berkshire works historically. He likes to buy undervalued things. He doesn't like to chase the high valued things. Berkshire always underperforms when the market is trending higher and overperforms when the market is trending lower. They do well over time, obviously, but that's their MO, and because of their methodology. And the fact that we're breaking above the 50-day moving average today, I think that we need to watch and see if we get follow through from that tomorrow, and then the resistance at 490 is so close. Maybe if we hit that 490 level tomorrow or the next day, and then we go sideways for a couple days, kind of like this here. Once again, it tried to break above it back in June, no follow through day, so we came back down. So I think that's kind of what we want to look for, but with a follow through day, and then Berkshire could run up well past 500 up to 520, I think would be a very logical target for it. But let's give it another day or two, Will, and see where that goes. Seems like you're going a little more conservative as well, Will, with some of the questions that you're asking. Some of these things that tend to be a little more places to hide.
Very well. Question from Abhishek on Iron, IREN.
Again, why I love doing TradeFinder every week. You guys always come up with symbols that we don't look at week in and week out with the same names. And this is a good pattern. I don't think I've looked at this one in quite some time. We came down, we held support there at 15, so we did look at it at some point because that line's drawn there. Another great feature of the software is it reminds you of what you looked at last time. So we broke above that 15 level, came back, tested it perfectly, moving higher. We're at the 10-day moving average on the low, but not too surprising that it got turned back from that wave 3 high. Let's see if it can hold this 10-day moving average and turn and bounce higher. So this is the aggressive conservative approach again. We all have different risk tolerances. You have to trade within your own risk tolerances. Some people are naturally more aggressive. Some people are naturally more conservative. There's no right or wrong. It's what the way you feel, and you should trade according to those so that you don't deal with too much anxiety in the world of trading. There's anxiety enough because we have money at risk, but if we can hold the 10-day moving average and bounce back up, take another run at that wave 3 high, there's plenty of room to the upside. So I don't think there's any reason to get too aggressive here. But the aggressive move would be if we hold the 10-day moving average and bounce tomorrow. You could take a shot at it, but know that there is that resistance lying right there at that wave 3 high. The more conservative approach would be let it break that wave 3 high. The algorithm does feel that that was enough on the wave 4, and so this is just sideways backing and filling here. But a conservative approach, let it break that wave 3 high, and then you got room up to the wave 5.
Thanks, Rob. I see we're approaching time. I know you still want to get into the case study consideration. As always, we have lots of well thought out, outstanding questions, but you just tell me if you want to transition over to the case study consideration.
Yeah, let's do one more, and then I do want to opine a little bit on the case study consideration this week because we are going to leave the U.S. market on this as it seems to be some rotation internationally. So I kind of like the one that we have. So one more, and then we'll do that.
All right. The last one will be Seaboard, which is SEB.
Another one we don't look at a lot. This is just such a good show. On the Amex, well, interesting. Wow. Heck of a move based on that price. I assume that's not the IPO, that it moved to the Amex. And little bit, not the most classic stair step like we had in Ethereum, but similar, where you go vertical, you consolidate the move, and then you go vertical again, and then you go, this looks like you're going up a set of stairs, hence the name of the pattern as a stair step pattern. So the fact that it's holding here nicely above the 10-day moving average, this one is fairly easy from a read. If you're long, no reason from a technical standpoint to exit. If you're looking for an entry, probably could go ahead and do it now because the stop is very easy. It's right there at 3,500. If we break below that, then it could be a Katie bar the door all the way back down here towards the 3,100, 3,000 level because it was so vertical moving up. But if we get that next stair up, you could get another vertical move higher here. So you stay long as it holds 3,500. If it breaks that, that's your stop. Get out right away because Yeah, there's a vacuum there on it, could move down quite a bit. Interesting one to finish with. All right, so going over to, I talked about those AI signals that the hub organization uses with their data scientists. Now, I do want to caution everyone that this symbol is only a 61% chance, rounded up to 62, very similar to the same score. In fact, it's the exact same score that it showed for the S&P to go up to 652. We got to 650. We didn't quite hit 652 before we pulled back here a little bit. But this is on an ETF for Japan, who seems to be kind of coming back from the dead in their equities world with negative rates that they had for the longest time. But look at this zigzag pattern that exists in the wave three here, which I did look at. So we had a perfect 50% corrective move here. That yields a 100% extension. So that's all the zigzag is saying that we're supposed to do. It's hit its target. It's a little overbought right now from the 10-day moving average. But then the question is, what's the likelihood that you get an extended C wave, which could propel it up towards that AI target around 135? Oftentimes, as you know from listening, C waves do extend to the next fib level, even though, once again, to be clear, it's already done what it's supposed to do. So it's been a satisfied zigzag pattern. But we often get the extended level. And with money rotating, I think that could happen there. You look at the volume and you can see there's been some increased volume here. These sellers got turned away. They tried to push it back down. They were unsuccessful. Buyers came in. And then we look at the DMI here and is forming quite well. It's above the both 20 and 25 levels. I like the ADX breaking above the negative directional indicator and going above 20. If you look at the internet, the pure reading on the DMI is wait for the ADX to go above 25. It's been my experience. If you have a well-constructed DMI and it breaks above 20, it's likely going to break 25 as well. The turn back usually occurs at 20. So if it can break above 20, then you get a little extra part of the move as it breaks from 20 to 25. So we're going to look at this chart here. And just a quick reminder, if you're interested in following this, that the AI signal we prefer 75% to send out alerts at ewotrader.com. I'm pretty comfortable with a 70% score. That's still greater than the average performance of any traders in the market. So 62 is still a little bit low, but it's more than a toss of a coin. And with the thing that I find most interesting about it is with the seeming rotation internationally, some money leaving the U.S. and the uncertainty of what the Fed's going to do. Has put a bid here. So I do like this one to have an extended C wave. So we'll call this one an actual idea, Zach, if you want to show them how to do that.
Yeah, let's do that. It's been a few sessions since we've
It is.
posted a official idea, as you said. So I'm going to go ahead and take the screen. I'll stop your share. So you'll have to share again after I finish up posting the idea. So as we can see now, we are at the login screen for the Hub platform. And as we're loading in, we'll notice up here at the right toolbar, we have this light bulb for the ideas. As Rob alluded to a bit earlier, the past few sessions have been posts where it's a bit more of a discussion in this scenario. The criteria isn't fully met for it to be an official idea, but for today's case study consideration on DJX, it is going to be an official idea. So
It
going
is,
into the
yes.
symbol search window here. Oh, sorry.
It's DXJ.
DXJ, a little dyslexia there, huh? Apologies. And that's on the this one.
NYSE, the top one.
Oh, looked right past it. All right. And the target price we're looking at for that one?
Let's go with the 161 level, not the extended AI level. So we'll be slightly more conservative and go 132.
Very well. 132 is going to be our target price. We'll go down to our time frame selection.
3 months.
3 months. So as we can see, we have these fixed intervals of time to select. So we're going to go a quarter out or 3 months. We'll come back and make this look nice and detailed right after this session concludes. But I am going to go ahead and confirm, post this idea or publish this idea rather. So as you can see, it's now here posted on the platform, and we encourage you to interact. As I've said many times, for those that have been around, have heard this, for anyone that might be new or joining us for the first time, we encourage your opinion, whether you agree or disagree. Just always include your supporting evidence, and obviously being considerate of everyone in the community, and just strictly sticking to your opinion and the overall statistics and analysis around whatever symbol idea it may be. Opposing opinions is what makes markets, and if everyone agreed on every single trade, there'd be no trades. Always has to be a buyer and a seller. So that'll wrap up my soapbox speech for today's session, and I'll pass it back over to you, Rob.
All right. I'll take the screen back and give them one last look at the chart here from Elliott Wave and AI standpoint. And yeah, your point is well made. And I would like to add in that, when I do these US market updates, every now and then somebody comes out with a real negative. I always welcome opposing views because of exactly what you said. But let's just keep it respectful. We're all human beings, and we're just giving our opinion, our analysis. If you disagree, great, it's fine. Love to hear your opinion and what you think. But there's no reason to trash somebody else. And I will say that this social media aspect of the software, which is really cool, having a technical software um, piece that has the social media aspect to it. The comments, I haven't really seen anyone that was crossing the line on a disagreeing uh, uh, position, and I think that's great. Let's just be respectful of each other. Somebody's going to be right, somebody's going to be wrong on opposing opinions, and no matter how cocky you may get on your opinion, I promise you, you'll be wrong at some point in time. So there's no reason to say anything negative to anybody else, and the community tends to respect that and not do it. It's a great place to share ideas and see opposing opinions, and maybe somebody comes up with something you haven't thought of, and it's a learning tool from that standpoint as well. So with that, thanks as always for your attention during the live trading day. No idea what's going to happen between now and Friday, other than I think Friday will be a volatile day, and the markets have continued down just a bit today, as we are maybe pricing in the possibility that Chairman Powell may continue his hawkishness on Friday. It does seem like there are a few more Fed governors that are leaning towards a rate cut. Would they officially dissent at the September meeting? We'll wait and see. But we appreciate your time, value it very much. Time is the most valuable asset we all have. Thanks for spending some of your trading day with us. Look forward to talking again soon.